You're sitting at your computer, watching your investment portfolio plummet into the red. Your heart races as you see your hard-earned money disappearing before your eyes. This isn't just a nightmare, it's the reality for 90% of investors who lose money in the markets. But here's the thing, you don't have to be part of that statistic. Before we dive deep into the strategies and secrets that separate successful investors from the losing crowd, I want to offer you something special. Click the link below to download my free Profitable Investors Playbook. It contains all the templates, checklists, and tools you'll need to implement everything we're about to discuss. Don't wait until after the video. Grab it now while it's fresh in your mind. Now, let's talk about why most investors fail and, more importantly, how you can join the elite 10% who consistently make money in the markets. The truth might surprise you, it's not about having insider information or advanced degrees in finance. The most successful investors share common habits, mindsets, and strategies that anyone can learn and implement. Think about the last time you made an investment decision. Were you driven by fear of missing out? Did you jump in because everyone else was talking about that hot new stock? This emotional decision-making is exactly what separates the winners from the losers in the investment world. The successful 10% understand that investing isn't about following the crowd or making snap decisions based on headlines. Let me share a story that perfectly illustrates this point. Back in 2008, when the financial markets were in complete chaos, most investors were panic selling everything they owned. But Warren Buffett was buying. He wasn't just buying small positions, he was making billion-dollar investments in companies like Goldman Sachs. While everyone else was running for the exits, he was calmly following his proven investment strategy. The result? Those investments made during the crisis yielded returns of over 40% annually. This brings us to our first crucial lesson. Successful investors think differently. They don't see market downturns as disasters, they see them as opportunities. They don't follow the crowd. They do their own research and stick to their strategy regardless of what others are doing. But how do you develop this mindset? It starts with understanding that investing is not gambling, it's a systematic approach to building wealth over time. The foundation of successful investing begins with proper education and understanding. You wouldn't try to perform surgery without going to medical school. So why would you invest your life savings without proper knowledge? The successful 10% spend considerable time learning about different investment vehicles, understanding market dynamics, and studying successful investors' strategies. One of the biggest mistakes new investors make is jumping straight into trading without understanding the basics of financial markets. They hear about someone making a fortune in cryptocurrency or day trading, and they want to replicate that success immediately. But here's what they don't see. Behind every overnight success story are countless hours of learning, practicing, and developing a solid strategy. Let's talk about strategy for a moment. The most successful investors all have one thing in common: they have a clear, well-defined investment strategy that they follow religiously. This strategy isn't based on hunches or hot tips, it's based on thorough research, risk management, and clear objectives. Your strategy should answer fundamental questions like, what are your investment goals? What's your risk tolerance? What's your investment timeline? Without clear answers to these questions, you're essentially driving blindfolded. Risk management is another crucial element that separates the successful 10% from the losing 90%. Most failed investors put too much money into single investments, fail to diversify properly, or use excessive leverage without understanding the risks. Successful investors, on the other hand, never risk more than they can afford to lose and always have a clear exit strategy for every position they take. The power of diversification cannot be overstated. But here's the catch: true diversification isn't just about buying different stocks, it's about spreading your investments across different asset classes, sectors, and geographical regions. Think about it like this: if you own 10 different technology stocks, you're not really diversified. If the tech sector takes a hit, all your investments will suffer simultaneously. Time in the market beats timing the market. This is a principle that successful investors understand deeply. While the losing 90% are constantly trying to predict market tops and bottoms, the winning 10% focus on building long-term positions in quality investments. They understand that wealth is built through compound interest over time, not through quick trades and market timing. Let's talk about the power of compound interest for a moment. Albert Einstein allegedly called it the eighth wonder of the world, and for good reason. Consider this example: if you invest $10,000 with an annual return of 10%, after 30 years you'll have nearly $175,000, without adding a single dollar more to your initial investment. This is why successful investors start early and stay invested for the long term. Another crucial aspect of successful investing is understanding and managing your emotions. Fear and greed are the two most powerful emotions that drive investment decisions, and they're usually wrong. When everyone is fearful, opportunities are often the greatest. When everyone is greedy, risks are usually highest. The successful 10% have learned to control these emotions and make decisions based on analysis rather than feeling. Information management is another key differentiator. In today's world, we're bombarded with financial news, tips, and recommendations 24/7. The losing 90% try to follow everything and end up overwhelmed and confused. The winning 10% have learned to filter out the noise and focus on what truly matters. They have reliable sources of information and know how to separate facts from hype. Technical analysis can be a valuable tool, but it's often misused by novice investors. The successful 10% understand that technical indicators are just one piece of the puzzle. They need to be combined with fundamental analysis, market sentiment, and a solid understanding of the broader economic environment. They don't make decisions based on a single indicator or pattern. Fundamental analysis is equally important. Successful investors know how to read financial statements, understand key metrics, and evaluate a company's competitive position in its industry. They don't just look at price charts, they understand the business behind the stock. This deeper understanding helps them make more informed decisions and stay confident in their positions during market volatility. Speaking of volatility, let's address how successful investors handle market downturns. While the losing 90% panic and sell at the worst possible times, the winning 10% see market corrections as buying opportunities. They understand that markets move in cycles, and downturns are a natural part of these cycles. In fact, many of the most successful investors make their best investments during market corrections. Portfolio rebalancing is another practice that separates successful investors from the crowd. Over time, some investments will perform better than others, causing your portfolio to drift from its target allocation. The winning 10% regularly review and rebalance their portfolios to maintain their desired asset allocation. This disciplined approach helps them sell high and buy low automatically. Let's talk about the importance of having a written investment plan. The successful 10% don't just keep their strategy in their head, they write it down and review it regularly. This written plan includes their investment goals, risk tolerance, asset allocation targets, and criteria for buying and selling investments. Having this written plan helps them stay disciplined and avoid emotional decisions during market turbulence. Cost management is another area where successful investors excel. They understand that fees, commissions, and taxes can significantly impact their returns over time. They choose low-cost investment vehicles when appropriate, minimize trading frequency to reduce commission costs, and consider tax implications in their investment decisions. Every dollar saved in costs is a dollar that can compound over time. The role of patience in successful investing cannot be overstated. The losing 90% are constantly looking for quick profits and jumping from one investment to another. The winning 10% understand that true wealth is built over time through patient, disciplined investing. They're willing to hold positions for years or even decades if the investment thesis remains valid. Another crucial aspect is understanding market cycles. The successful 10% know that markets move in cycles, and different assets perform differently during various phases of these cycles. They adjust their strategy based on where we are in the cycle, rather than trying to fight against it. This understanding helps them position their portfolios for success regardless of market conditions. Risk management goes beyond just diversification. Successful investors use various tools and techniques to protect their portfolios, including position sizing, stop-loss orders, and options strategies when appropriate. They understand that protecting their capital is just as important as growing it. After all, you need to avoid big losses to keep your money compounding over time. The importance of continuous learning cannot be overemphasized. The winning 10% never stop educating themselves about markets, investment strategies, and new opportunities. They read books, attend seminars, study successful investors, and constantly work to improve their knowledge and skills. They understand that markets are always evolving, and they need to evolve with them. Record keeping is another practice that separates successful investors from the crowd. They maintain detailed records of their investments, including their reasoning for each decision, lessons learned from both successes and failures, and regular portfolio reviews. These records help them improve their decision-making process over time and avoid repeating mistakes. Let's address the role of technology in successful investing. While the losing 90% might chase every new trading app or investment platform, The winning 10% use technology selectively to enhance their strategy. They leverage tools for research, analysis, and portfolio management, but they don't let technology drive their investment decisions. The power of networking should not be underestimated. Successful investors often build networks of like-minded individuals who share insights, discuss strategies, and provide support during difficult market conditions. They understand that while they need to make their own decisions, they can learn valuable lessons from others' experiences. Another key difference is how successful investors handle success and failure. The losing 90% often become overconfident after a few successful trades or completely give up after failures. The winning 10% maintain their discipline regardless of recent results. They learn from both their successes and failures, always focusing on improving their process rather than just the outcomes. The role of macroeconomic factors in investment success cannot be ignored. Successful investors understand how factors like interest rates, inflation, government policies, and global economic trends affect different investments. They adjust their strategies based on these factors while still maintaining their core investment principles. Let's talk about the importance of having multiple income streams. The successful 10% often don't rely solely on trading or investing for their income. They build multiple streams of income, which allows them to invest more patiently and avoid making desperate decisions based on short-term cash needs. This financial flexibility is a crucial advantage in their investment success. The power of contrarian thinking is another characteristic of successful investors. While the losing 90% follow the crowd, the winning 10% are often willing to take positions opposite to popular opinion when their analysis supports it. This doesn't mean they're always contrarian, but they're willing to go against the crowd when opportunities arise. Understanding market psychology is crucial for investment success. The winning 10% know that markets are driven by human emotions in the short term, but fundamentals matter in the long term. They use this understanding to stay rational when others are emotional and to identify opportunities when market psychology creates mispriced assets. The role of proper position sizing cannot be overstated. Successful investors never risk too much on any single investment, no matter how confident they are in their analysis. They understand that even the best investments can go wrong, and proper position sizing ensures that no single failure can severely damage their portfolio.